Welcome. Today we're diving into the world of component recognition and accounting. If you've ever wondered why companies break down their assets into smaller parts for accounting purposes, you're in the right place. We'll explore what component recognition means, why it's important, and when it's required. By the end, you'll have a clear understanding of how this process works and why it's a vital part of modern accounting practices. Let's start by defining what component recognition actually is and why it's become a key topic for accountants and auditors worldwide. Component recognition is the process of identifying and accounting for significant parts of an asset separately. Instead of treating a complex asset like a building or a machine as a single item, accountants break it down into its major components. Each component is then accounted for individually, especially if it has a different useful life or depreciation pattern. This approach ensures more accurate financial reporting and better reflects the true value and wear and tear of each part of the asset. Now, let's see why this is necessary in the first place. Why do we need component accounting? The main reason is accuracy. Different parts of an asset may wear out or need replacement at different times. By recognizing components separately, companies can match expenses with the periods in which they occur, leading to more precise profit calculations. This also helps in planning for future replacements and maintenance, ensuring that financial statements are not misleading. It's all about providing a clearer picture of a company's assets and their real value over time. Component accounting is required when an asset has significant parts with different useful lives or depreciation methods. For example, a building may have a roof, elevators, and heating systems, each with its own lifespan. If these components are material to the asset's total value, accounting standards require them to be recognized and depreciated separately. This requirement is especially important under international accounting standards, which aim to enhance transparency and comparability across companies. Let's look at a practical example. Imagine a company owns an office building. The building itself, the elevators, and the air conditioning system all have different expected lifespans. Instead of depreciating the entire building as one asset, the company recognizes each major component separately. This means the cost of replacing the elevator, for instance, is accounted for when it actually happens, rather than being spread over the life of the whole building. This approach leads to more accurate financial statements. Another example is an airline company. An aircraft consists of engines, landing gear, and the main body, each with different maintenance schedules and useful lives. By recognizing these as separate components, the airline can better track costs and plan for replacements. When an engine is replaced, only the engine's value is adjusted in the books, not the entire aircraft. This method ensures that the company's financial records reflect the true condition and value of its fleet. When a company acquires a complex asset, it must allocate the purchase price among its significant components. This initial accounting step involves estimating the cost of each part based on its relative value and expected lifespan. Proper allocation ensures that each component is depreciated over its own useful life, rather than the life of the entire asset. This process may require input from engineers or appraisers to determine fair values for each component. Once the components are identified and valued, each is depreciated separately. This means that when a component reaches the end of its useful life, only that part is written off, not the entire asset. For example, if a roof is expected to last 20 years and the building 50 years, the roof's cost is spread over 20 years, while the building's structure is depreciated over 50. This method provides a more accurate reflection of asset consumption and replacement need. When a component is replaced, its carrying amount is removed from the books, and the cost of the new component is capitalized. For instance, if a company replaces the elevators in a building, the old elevator's value is derecognized and the new ones are added as a new asset component. This process ensures that the asset's book value remains accurate and up-to-date, reflecting only the current usable parts. Major inspections are another important aspect of component accounting. Some assets require regular, significant inspections to ensure safety and functionality, like aircraft or industrial equipment. The cost of these inspections is treated as a separate component and capitalized, then depreciated over the period until the next inspection. When a new inspection occurs, the previous inspection's cost is removed from the books. This approach aligns expenses with the periods they benefit. Let's look at how to record the initial recognition of components. When an asset is purchased, the total cost is allocated among its components. For each component, a separate asset account is debited and the total cash or payable is credited. This ensures that each component is tracked individually from the start, setting the stage for accurate depreciation and replacement accounting down the line. When a component is replaced, the carrying amount of the old component is removed from the books with a credit, and the cost of the new component is debited to the asset account. Any difference between the old carrying amount and the new cost is recognized as a gain or loss. This process keeps the asset's value accurate and ensures that depreciation is calculated on the new component going forward. For major inspections, the cost is capitalized and depreciated over the period until the next inspection. When a new inspection occurs, the previous inspection's cost is derecognized. The journal entry involves debiting the asset account for the new inspection and crediting the old inspection's carrying amount. This ensures that only the current inspection cost is reflected in the books. One of the biggest advantages of component accounting is more accurate depreciation. By matching each component's cost to its actual useful life, companies avoid over or under-depreciating their assets. This leads to more reliable financial statements and better decision-making for asset management and replacement planning. Component accounting also enhances transparency. By showing the value and depreciation of each major part of an asset, stakeholders get a clearer view of a company's true financial position. This transparency builds trust with investors, regulators, and management, making it easier to justify asset-related decisions. With component accounting, companies can manage their assets more effectively. By tracking each component's value and replacement schedule, maintenance and capital expenditure planning become more precise. This proactive approach helps avoid unexpected costs and ensures assets are always in optimal condition. Despite its benefits, component accounting can be complex. Identifying significant components, estimating their values, and tracking replacements require detailed records and sometimes expert input. Smaller companies may find the process resource-intensive, but the accuracy and transparency gained often outweigh the challenges. International accounting standards such as IFRS require component accounting for property, plant, and equipment when components are significant. These standards set clear guidelines for identifying, valuing, and depreciating components, ensuring consistency across companies and industries. Adhering to these standards is essential for compliance and comparability. In practice, companies often use specialized software to manage component accounting. These tools help track each component's value, depreciation, and replacement history. Regular reviews and updates ensure that records remain accurate, especially after major repairs or replacements. This practical approach streamlines the process and reduces the risk of errors. Sum up: component recognition and accounting provide a more accurate and transparent way to manage complex assets. By identifying, valuing, and depreciating significant components separately, companies ensure their financial statements reflect the true condition and value of their assets. While the process can be detailed, the benefits in accuracy, transparency, and asset management are substantial. Component accounting is a powerful tool for modern businesses. It not only improves the accuracy of financial reporting, but also supports better decision-making and asset management. As accounting standards continue to evolve, understanding and applying component recognition will remain a crucial skill for finance professionals. Thanks for joining us on this journey through component accounting.